Hello, and welcome back to Road to Financial Freedom. Today, we're tackling a topic that impacts everyone around the globe: recessions. Have you ever wondered why economies suddenly slow down, leading to job losses and business closures? Or how countries recover and bounce back stronger? If these questions intrigue you, you're in the right place. In this video, we'll break down what a recession is, what causes it, its effects on everyday life, and the path to recovery. Before we get started, make sure to hit that subscribe button and ring the bell so you never miss out on our latest videos. If you're new here, welcome. Our channel is dedicated to helping you achieve financial freedom through insightful tips and strategies. Stick around until the end of this video, because understanding recessions can equip you with the knowledge to better navigate economic downturns. Let's start with the basics. What exactly is a recession? A recession is typically defined as a significant decline in economic activity that lasts for an extended period, usually visible in GDP, employment, and other key economic indicators. The most commonly accepted definition is 2 consecutive quarters of negative GDP growth. However, recessions are more than just numbers. They represent a period of economic hardship where businesses struggle, unemployment rises, and consumer confidence drops. Recessions can be triggered by various factors, including economic shocks, high interest rates, reduced consumer spending, and declining investments. Understanding the causes of recessions is crucial. Here are some of the primary factors that can lead to an economic downturn. Economic shocks. Unexpected events like natural disasters, geopolitical tensions, or pandemics can disrupt economic activity. For example, the COVID-19 pandemic led to a global recession as businesses shut down and consumer spending plummeted. High interest rates. Central banks may raise interest rates to combat inflation, making borrowing more expensive. This can reduce consumer spending and business investment, leading to a slowdown in economic activity. Reduced consumer confidence. When consumers lose confidence in the economy, they tend to cut back on spending. This decrease in demand can lead to lower production, layoffs, and further economic decline. Falling investment. Businesses may reduce investment in new projects and technologies due to uncertainty or reduced access to credit. This can slow economic growth and contribute to a recession. High inflation. While moderate inflation is normal, excessively high inflation can erode purchasing power and reduce consumer spending. Central banks may raise interest rates to combat inflation, potentially triggering a recession. Asset bubbles. When asset prices such as real estate or stocks rise rapidly and unsustainably, they can create bubbles. When these bubbles burst, it can lead to financial crises and economic downturns. Recessions have widespread and often severe effects on individuals, businesses, and governments. Let's explore some of these impacts. Unemployment. One of the most immediate effects of a recession is rising unemployment. As businesses cut costs, they often reduce their workforce, leading to job losses and higher unemployment rates. Declining business profits. During a recession, consumer spending typically decreases, leading to lower sales and profits for businesses. This can result in business closures, especially for smaller enterprises. Reduced consumer spending. With higher unemployment and reduced income, consumers tend to cut back on spending. This further exacerbates the economic downturn as businesses see lower demand for their products and services. Falling stock markets. Recessions often lead to declining stock prices as investors lose confidence in the economy and sell off their investments. This can reduce household wealth and further dampen consumer spending. Government debt. To combat the effects of a recession, governments often increase spending on social programs and economic stimulus measures. This can lead to higher government debt and budget deficits. Social impacts. Recessions can also have significant social impacts, including increased poverty, reduced access to healthcare and education, and greater social unrest. Recovering from a recession is a complex process that involves coordinated efforts by governments, businesses, and individuals. Here's how economies typically bounce back. Government intervention. Governments often play a crucial role in recovery through fiscal and monetary policies. Fiscal policies might include increased public spending, tax cuts, and direct financial aid to individuals and businesses. Monetary policies often involve lowering interest rates to stimulate borrowing and spending. Business adaptation. Businesses may adapt to new economic conditions by innovating, cutting costs, and finding new markets. This can help them survive the downturn and position themselves for growth during the recovery. Consumer confidence. Recovery is also driven by a rebound in consumer confidence. As people feel more secure about their jobs and financial situation, they are more likely to spend, which stimulates economic activity. Investment in infrastructure. Governments often invest in infrastructure projects during a recession. These projects create jobs and improve long-term economic productivity, helping to drive recovery. Global trade. International trade can also play a key role in recovery. As global economic conditions improve, demand for exports can boost domestic production and employment. Technological innovation. Recessions can spur technological innovation as businesses seek new ways to cut costs and improve efficiency. Innovations developed during tough economic times can lead to long-term growth and productivity gains. Let's look at some historical examples to understand how recessions have unfolded and how economies have recovered. The Great Depression, 1929 to 1939, one of the most severe economic downturn in history. The Great Depression saw massive unemployment, bank failures, and deflation. Recovery began with government intervention, including the New Deal programs in the United States, which focused on public works, financial reforms, and social safety nets. The 2008 financial crisis, triggered by the collapse of the housing market and the failure of major financial institutions, the 2008 financial crisis led to a global recession. Recovery efforts included massive government bailouts, monetary easing, and regulatory reforms to stabilize the financial system. The COVID-19 recession, the pandemic-induced recession of 2020, was marked by unprecedented economic shutdowns and job losses. Governments worldwide responded with stimulus packages, direct financial aid, and public health measures. The rollout of vaccines and the gradual reopening of economies have been key to recovery. While recessions are a natural part of the economic cycle, there are steps individuals and businesses can take to prepare for and mitigate their impact. Build an emergency fund. Having a financial cushion can help you weather periods of unemployment or reduced income. Aim to save 3 to 6 months' worth of living expenses. Diversify income sources. Relying on multiple income streams, such as investments, side businesses, or freelance work, can provide financial stability during economic downturns. Stay informed. Keeping abreast of economic news and trends can help you anticipate potential recessions and make informed financial decisions. Invest wisely. Diversify your investments to spread risk and consider safe haven assets like bonds or gold, which tend to perform well during economic downturns. Enhance your skills. Continuously improving your skills and qualifications can increase your employability and job security during tough economic times. In conclusion, understanding recessions, their causes, effects, and recovery mechanisms can help you better navigate economic downturns and protect your financial well-being. By staying informed, preparing in advance, and making strategic financial decisions, you can mitigate the impact of recessions and position yourself for success during economic recoveries. If you found this video helpful, make sure to give it a thumbs up and subscribe to Road to Financial Freedom. We've got plenty more content designed to help you navigate the complex world of finance and investing. Be sure to check out our other videos for more tips and strategies on making smart money choices. Thanks for watching, and we'll see you in the next video.